Welcome to S&P Capital IQ's monthly loan market clip. I'm Steve Miller of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent trends in the loan market. In preview, loan prices climbed in December on the back of strong technical conditions. Looking ahead, participants expect demand to continue to lead supply in early 2013, allowing the bullish sentiment to persist. Before diving into our usual monthly commentary, let's review 2012's headline numbers. All in all, it was a strong year for loans. Bolstered by robust demand, benign credit conditions, and a relatively calm macro picture, the S&P LSTA index posted a 9.6% increase as prices pushed ever closer to par. Amid this supportive environment, new issue volume expanded to a 5-year high of $465 billion, putting 2012 behind only 2006 and 2007 on the historical leaderboard. Meanwhile, with investors searching for yield, the number of active accounts buying loans also reached a 5-year high of 268. Getting back to recent trends, the loan market ended 2012 on an up note. Rising loan prices generated a 79 basis point return for the S&P LSTA index. Levels were up further in early January. LCD's flow name composite, a measure of the 15 most liquid names in the market, reached 99.8 on January 14th, the highest reading since June of 2007. As this implies, muscular demand prevailed in December, mainly as a result of the resurgent CLO sector, which saw another $7 billion of new prints. For all of 2012, CLO volume was $54 billion, a more than four-fold increase from 2011, and yet another 5-year high. Mutual fund inflows also continued apace in December as retail investors sought out relatively high-yielding opportunities. Rising supply didn't keep pace with demand in December, reinforcing the market's firm tone. Still, the amount of S&P LSTA index loans outstanding grew to $550 billion at year-end, the most in 39 months. With the market rallying, the average new issue clearing yield of institutional loans sank to a near post-credit crunch low. Double B loans cleared in a 4 to 4.5% context, while single B loans printed in a 5.5 to 6% band. In addition to printing tightly, issuers took advantage of hot market conditions to drive covenant-light loan volume to roughly 50% of overall institutional loan issuance in December, the highest percentage ever. As a result, the percent of S&P LSTA loans with only incurrence test stood at a record 30% at year-end, up from 25% when 2011 drew to a close. Switching gears, the loan default rate in December was effectively unchanged at 1.3%. That is up from a near-record low of 17 basis points at the end of 2011, but about 2 percentage points inside the historical average. Looking ahead, managers expect default rates to reach 2% or so over the next 12 months. To wrap up, 3 final points. Looking ahead, managers say capital continues to pour into the market from all quarters as investors look for floating rate wide margin opportunities. The CLO pipeline remains chock-a-block, while loan mutual fund inflows in early January were running at roughly $100 million a day. As well, pension funds and other institutional investors were still actively putting money to work in the space. On the other side of technical ledger, the calendar of new issue loans was light when 2013 opened. Arrangers expect LBO and other M&A-driven volume to pick up later in the first quarter, but for the time being, supply is constrained. Finally, players continue to worry about all the obvious macro risks to the market, starting with the debt ceiling situation and continuing through all the hotspots around the globe. That brings us to the end of our overview. For more information on the market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description below. Also, you can download this presentation at slideshare.net.